Thank you, Member Toomey.
Thank you, Mr. Chairman, and Ms. Lang, welcome. Thank you for coming to the committee. Thanks for taking the time to chat recently. I enjoyed our conversation. It was about 2 months ago that this committee held its first hearing on stablecoins, and I was encouraged to hear from our witnesses about the essential role that stablecoins play in the larger cryptocurrency trading ecosystem. But it's also important to note the tremendous potential stablecoins have to be adopted as a common medium of exchange in the broader ordinary goods and services economy. Unlike cryptocurrencies that fluctuate in value, stablecoins are designed to maintain a one-to-one value relative to some reference asset, typically a fiat currency, such as the US dollar. Put simply, one stablecoin is meant always to be worth $1. Because of this price stability, stablecoins have the potential to serve all the traditional functions of money by acting as a medium of exchange, unit of account, as well as a store of value. Stablecoins can also improve upon traditional forms of money by increasing payment speed, especially cross-border transfers, reducing transaction costs, and helping to combat illicit finance through the creation of an immutable and transparent transaction record. Stablecoins can also be programmed to execute payments automatically upon the occurrence of some pre-designated verifiable event. This capability in particular has the potential to transform finance and, in time, much of our economy. Any regulatory regime for stablecoins will inevitably focus on consumer protections and systemic stability. But at least as important will be preserving the tremendous, unimaginable benefits that will flow from future innovations. As stablecoin usage has grown significantly, regulators have increasingly taken an interest. In last November's report from the President's Working Group on Financial Markets, spearheaded by Ms. Lang, appropriately recommended that Congress pass legislation to establish a federal regulatory framework for stablecoins. The PWG report recommends Congress address 3 perceived prudential concerns. First, stablecoin runs. Second, payment system risks. And third, systemic risk and concentration of economic power. Now, the principal recommendation is that stablecoin issuance be limited to insured depository institutions. Now, I commend the contribution to the public discussion that the PWG has contributed, but I strongly disagree with that particular recommendation. I think we can protect against concerns such as run risk through a less restrictive and more appropriately tailored approach. So to accomplish those objectives, I released a set of guiding principles for stablecoin legislation. These principles recognize that stablecoin issuers have significantly different business models than banks, and they present different risks. For example, stablecoin issuers typically neither make loans nor deposits, nor take deposits. They may choose not to transform maturity or to intermediate credit risk. And as such, stablecoin issuers using cash or cash equivalents to back its coin is likely safer than most existing financial institutions. Because of these differences, it would be inappropriate to subject stablecoin issuers to the full range of bank regulations meant to address risks posed by the fractional reserve deposit and lending banking system. So I was encouraged that Ms. Lang has recognized these differences and sensibly agreed that there should be regulatory flexibility for stablecoin issuers not engaged in traditional banking. But that does raise the natural question: why require all stablecoin issuers to become insured depository institutions then? My legislation will take a different approach. It will provide regulatory treatment that is flexible and adaptable to future technological innovation. It'll also promote competition in the stablecoin market by allowing at least 3 types of regulated entities to issue stablecoins. First, my legislation would preserve the regime to which the majority of stablecoin issuers are currently subject as state-registered money service businesses and money transmitters. To disrupt this regime would both introduce unnecessary burdens to an emerging technology and unwisely diminish the success of states with experience and expertise in this area. Rather than discard this regime, we should build on it to ensure the public has the right disclosures about stablecoin reserves to make an appropriately informed decision about whether to use any particular stablecoin. Second, my legislation will clarify that insured depository institutions are actually, in fact, permitted to issue stablecoins. The former head of the OCC, Brian Brooks, pioneered work to give banks clarity on digital asset activities, but the current OCC has created confusion regarding permissible activities. Finally, my approach will establish a new stablecoin charter with regulatory requirements designed specifically for stablecoin issuers. The requirements will address the risks identified by the PWG report, but will not force stablecoin issuers into a one-size-fits-all system created for traditional banks. Ms. Lang's recent testimony indicates to me that I think she agrees with the idea of a tailored approach for such issuers. Rather than just rely on the flexibility of the existing framework for depository institutions, which leaves full discretion of bank regulators, however, I think it's the responsibility of Congress to design this approach. So these three paths would allow each stablecoin issuer to choose the regulatory framework most appropriate for its own business model. Now, under this legislation, each stablecoin issuer would be required to meet certain minimum requirements regardless of the charter or license. For example, all would be required to disclose the assets that back the stablecoin. All would be required to adopt and clearly disclose redemption policies, and they'd have to undergo third-party audits. These requirements would ensure that consumers have sufficient information to choose which stablecoin they use. Ms. Lang's thoughtful comments on stablecoin regulation lead me to believe that there are many issues on which we can find common ground. So I look forward to developing legislation with my Senate colleagues and working with the administration to establish a regulatory framework for stablecoins that addresses potential risks while also encouraging innovation and competition. Thank you.
Thank you, Ranking Member Toomey. Today's witness, we'll hear from Nellie Liang, the Undersecretary of the Treasury for Domestic Finance. Madam Undersecretary, please proceed with your testimony. Thank you.
Chairman Brown, Ranking Member Toomey, and other members of the committee, thank you for the opportunity to testify this morning on stablecoin report by the President's Working Group on Financial Markets. The PWG is chaired by the Secretary of the Treasury and composed of the Federal Reserve Board, the SEC, and the CFTC. It was formed by a presidential executive order in response to the 1987 stock market crash and regularly produces reports on financial market issues for the President, which may include recommended legislative changes. For the stablecoin report, the PWG was joined by the FDIC and the OCC. Stablecoins are part of an emerging set of digital assets, activities, and services that could have profound implications for the U.S. financial system and economy. The distinguishing feature of stablecoins as compared to other digital assets is that they are designed to maintain a stable value relative to a reference asset, often the U.S. dollar. Stablecoins have grown rapidly from a market capitalization of roughly $5 billion at the start of 2020 to approximately $175 billion today. The PWG report focused on stablecoins because the offer of a stable value means they have the potential to be used widely as a means of payment by households, businesses, and financial firms. This potential use could create significant benefits for stablecoin users and payment transactions, but it could also pose risks. The PWG report focused on three prudential risks associated with the use of stablecoins for payments. First, run risk, a scenario in which loss of confidence in a stablecoin triggers a wave of redemptions, which could have spillover effects for the broader financial system. Second, payment risk, including operational issues that could interfere with the ability of users to store stablecoins or use them to make payments. And third, concerns related to concentration of economic power. For example, if a stablecoin provider scaled up quickly and gained market power as a provider of payment services. The PWG report found significant gaps in authorities that would address these prudential risks. Some of the largest stablecoin issuers operate with limited regulatory oversight, raising significant questions about whether their stablecoins are adequately backed. Even where a stablecoin issuer is subject to oversight, supervisors may not have sufficient visibility into the broader operations that support the use of stablecoins, which may be distributed across multiple entities. Neither state money transmitter nor securities law requirements were designed to address the financial stability payment system risks for a payment instrument based on new distributed ledger technology. To fill this regulatory gap, the PWG report recommended legislation to ensure that stablecoins are subject to a consistent and comprehensive framework that is proportionate to the risks posed. Such legislation would complement existing authorities with respect to market integrity, investor and consumer protection, and illicit finance. Specifically, the report recommended limiting issuance of stablecoins to insured depository institutions, giving supervisors of stablecoin issuers visibility into the broader stablecoin arrangements, and authority to set risk management standards for critical activities related to the use of stablecoins for payment, and certain measures to reduce concerns related to concentration of economic power. In developing the recommendation for stablecoin issuers to be insured depository institutions, the PWG report relied upon the flexibility that banking agencies would have to adjust for differences between stablecoin issuers and traditional commercial banks, and to adjust to new products and structures that may emerge over time. As noted at the beginning of my testimony, stablecoins are a subset of the large and quickly evolving digital assets market. The Treasury Department supports responsible innovation from digital assets, but is also committed to protecting against risks to users, the financial system, and the broader economy. The Biden administration continues to work across the agencies to develop a comprehensive strategy for all digital assets, with the goals of ensuring that cryptocurrency is not used for illicit finance, addressing risks related to financial stability and consumer and investor protection, and furthering financial inclusion and our continued leadership of the global financial system. We look forward to working with Congress on these critical issues as we make progress and appreciate the committee's leadership in this area. Thank you for the opportunity to testify this morning. I'd be happy to answer your questions.
Thank you, Madam Undersecretary. Stable coins are, as we know, only a few years old. We know most Americans have never bought one. Commercials in Silicon Valley just tell us stable coins are an innovation. I want to be clear, though, Madam Undersecretary, about the stakes here. How important is it we act now to regulate stable coins before they can hurt our economy? How could stable coins hurt working families if Congress and regulators don't rein in the risks of these products?
Thank you for your question, Senator Brown. As I mentioned, the digital asset market is growing very rapidly. The fundamental change is this new innovation that can allow for new provision of financial services and could radically change the way financial services are provided. This provides a lot of benefits, could bring efficiencies, especially to the payment system, and when we're speaking of cryptocurrencies. It also raises some of the concerns, of course, that you raised earlier on illicit finance, tax evasion, fraud, so it's important to address those issues. My view is, given these risks and the growth of the market, it's important for regulators and policymakers to take some actions to protect users and ensure the resilience of the financial system. Stablecoins are a subset of this digital asset space. The prospect of stable value gives them the potential to be used for payment transactions, a store of value, a medium of exchange. That raises a different set of risks. They have the ability to provide payments on 24/7, to reduce the costs of payments in a substantive way. I think it has the potential to be part of the future payment system. So I think it is important to assess the stability of stablecoins. Are they stable? Can they provide the services that they offer themselves to? The Secretary of the Treasury convened the PWG to evaluate whether they can be stable and to address whether this new product has an adequate regulatory framework. And the PWG report recommended that there should be additional authorities provided to regulators for this product.
Thank you. The stablecoin companies assure us they're transparent. They tell us they follow the law. They even say, they like to say they're built on trust. But of course they say that. They want to suggest if you buy stablecoins with dollars, your dollars will be safe. And you'll be able to exchange stablecoins back for dollars without a problem. Madam Undersecretary, is there any risk that people with stablecoin won't always be able to exchange stablecoin for dollars? If so, do these companies make that clear to consumers?
There is risk that stablecoins cannot deliver dollar. This is they say they're stablecoins. The assets backing the stablecoins may not be able to deliver a dollar under stress periods. And in fact, if you look at stablecoins, they do fluctuate. In addition, there's issues around redemption, as well as there could be fees that may not be disclosed. So I do think there are features of stablecoins that create run risk, which is the first risk that the PWG report
And
identified.
are those companies informing potential purchasers of stablecoin that there is that risk?
They are not required to by any regulators because they are not regulated.
Understand that, but are they doing that? Your experience?
So there are probably 50 or 60 different stablecoins at this point in time. I imagine the practices vary quite a bit.
I think it's worth your knowing that. The answer to that, are most of them, if there are 50 or 60, do they disclose the risk at all? It's just, I'm not asking right now. I am asking right now, but I think it's something important to know. Last question. For a long time in this country, we've prevented commercial companies from partnering with financial companies. In some ways, we've built a wall between the two. There have been reports that companies like Walmart might think about issuing a stable coin. Is anything right now stopping Amazon or Walmart or another big company from starting their own stable coin? And if so, what are the risks if they do that?
So currently, I don't believe, because stablecoin issuers are licensed by state money transmitter requirements, there is nothing that stops a commercial company from wanting to issue a stablecoin. The PWG proposal for an IDI for the issuer would preclude a commercial company from being an issuer. The PWG recommendations also are to consider for Congress to consider whether the custodial wallet providers or other service providers related to the stablecoin arrangement could be commercial or should be limited to financial. But this is an issue that Congress, the separation of banking and commerce has been an issue that Congress has grappled with over many times in different periods, and this is another area where it's an area for them to consider carefully.
Thank you, Madam Secretary. Senator Toomey.
Thank you, Mr. Chairman. Ms. Lang, so as I said, I appreciate the work that the PWG has done. I disagree with some of the conclusions, but it was a constructive addition to this ongoing public discussion. One of my criticisms is I don't think that the PWG report took sufficient account of the existing state-based regulatory framework. And as you just pointed out, stablecoin issuers do operate as state-based money transmitters, also trust companies. And it occurs to me that a stablecoin issued by a trust company, if it's backed solely by cash and cash equivalents, could very well be safer than many existing financial institutions, including many banks. It seems that be sensible for a trust company that issued such a safe, fully backed stablecoin ought to be subject to a different regulatory regime than a traditional bank because its business model is so different. So my question for you, if Congress were to authorize a well-defined charter that was specific to stablecoins for, let's say, this type of institution, a trust company that issues a stablecoin fully backed, do you think that could be designed in a manner that's consistent with safety and soundness?
Thank you for the question. So I believe that the regulation for stablecoins should be flexible, should reflect the risks of the stablecoin activity. And stablecoin issuers that issue only stablecoins, do not extend credit, should not need to be subject to the sort of full set of banking regulations that relate to credit provision. So flexibility, I agree, is very important. The trust charters, and this may vary across states, are designed more for, have been developed for fiduciary responsibilities. They may not be, as currently structured, have the authority to reach in and see how the whole stablecoin arrangement that is needed to be a payment service is conducted. And so I think as we've talked to state supervisors, and we've learned quite a lot from the experience they're building, they have less insight into the overall arrangement than at times they might like. So.
Yeah, and I guess that goes to the point that I was trying to make. I'm not suggesting that the existing state-based regime is perfect and we're finished and there's no work to be done here. But I am suggesting that it might serve as a part of a regulatory framework, an option that would be available with the overlay that would address some of the concerns that you just raised. Now, I appreciate you just once again reiterated a point that I think you've made before, that the full set of bank regulations really shouldn't need to apply if the issuer is not engaged in the full range of traditional banking. I think that's a really important distinction. And I think one of the things that we ought to consider is creating what some people call a narrow bank, a narrowly defined charter that would be well suited for stablecoin issuers. Do you think a narrow bank could be consistent with the goals of the PWG report?
On a specific type of charter, I guess I could more comfortable with the issues it's trying to address. So I think staying flexible within an IDI framework, which I believe is flexible, to better match the activities and risks with the regulation. It does not need, the PWG report did not necessarily recommend deposit insurance, for example. So that would be consistent with a narrow bank. But it did require, it would like financial firms to be issuers, and for other parts of the stablecoin arrangement, it could be commercial, but that would be something for Congress to consider. So I think in terms of a narrow bank, that can be defined separately. I think it's within the IDI charter with lots of flexibility to match the risks of the activities.
So where I think there's common ground here is a recognition that we both have that the nature of stable coins and their issuers is very distinct from traditional banking, and therefore a different regulatory approach makes sense. Where we might have, I'm not sure, but we might have somewhat different views is how clearly Congress should prescribe what that looks like. My own preference is not, I acknowledge there is a lot of regulatory discretion. I don't think that's the optimal way to proceed. I think it's better for Congress to provide some guide points. I want to make one last point, and I see I'm out of time. And that is, this is not a criticism of you. This is not an observation about Ms. Lang at all, but it's a general observation that Congress and regulators should remember our mission is not to make it impossible for a financial institution to fail. It is not to make it impossible for an investor to lose money. It is, in my view, to ensure that investors are well informed about the risks that they choose to take, and to make sure that if there is a financial institution that fails, it doesn't have catastrophic systemic consequences. I hope we'll keep that in mind as we go down this road. Thank you, Mr. Chairman.
Thanks, Senator Toomey. Senator Menendez from New Jersey is recognized from his office, I believe.